Hello everyone. Today we're jumping into a really powerful market framework. It's all about giving you a clear perspective on the two most critical elements in all of trading, time and price. The goal here is to build a systematic way to look at the market.
Welcome to AI Explains ICT. In this video, we're going to be breaking down the core content from Month 7, Episode 4. Now, this is a pretty dense topic with a lot of important details, so I definitely recommend grabbing a pen and paper to take some notes.
So, let's kick things off with the big question, the one every single trader asks. How can we build a systematic, repeatable process to get a real handle on where the market is likely to head next? Well, that's exactly what this framework is designed to help us answer.
Here's our game plan for this video. First, we're going to look at the two pillars of the market algorithm. Then, we'll dive into Step 1, which is all about look-back windows, and Step 2, the price hierarchy. After we've got the theory down, we'll see it all come to life in a case study. And finally, we'll wrap up by talking about how this gives you a real analytical edge. Let's get into it.
All right, first up, let's get to the core concept. To really understand where price is going, we need to start thinking like the algorithm that actually delivers it. And according to ICT, that algorithm runs on two fundamental pillars. And here they are, time and price. It's that simple, but the magic is in how they work together. On the left, we've got time, which we analyze using something called IPDA data ranges. And on the right, we have price, which we map out using PD arrays. The entire idea here is that when you blend these two elements together, you start to see the market with the same logic the algorithm uses.
So let's start with that first pillar, time. You see, we need a consistent way to look back at historical data, to get our bearings, to find our context. And that's exactly where these specific look-back windows come into play.
These windows are what ICT calls IPDA data ranges. Now, IPDA stands for Interbank Price Delivery Algorithm. The main idea is that this algorithm doesn't just look at all historical data randomly. Nope, it specifically references key look-back periods, 20, 40, and 60 trading days, to figure out what it's going to do next.
So what do these numbers actually mean in the real world? It's pretty straightforward, actually. 20 trading days gives you roughly 1 month of price action. 40 days is about 2 months, and 60 days gives us that 3-month or quarterly perspective. These specific time frames are what we use to frame our entire analysis.
Okay, so now that we've got our time frames locked in, let's move over to that second pillar, price. Because it's not enough to just know when the algorithm is looking back, we also have to know what it's looking for. And this is where the PD array matrix comes in. The best way to think about it is like a prioritized checklist of important price levels. The algorithm is always, and I mean always, seeking liquidity. It's either looking for a premium, a high price to sell, or a discount, a low price to buy. This matrix literally lists out the specific levels it's going after. And this right here is the hierarchy. It's a roadmap. If the price is trading up in a premium, the algorithm starts looking for reasons to go short. And it starts with the levels at the top of that list, like an old high or a bearish order block. If it punches through one, it just looks for the next level on the checklist. The exact same thing happens in a discount environment for buys. The most important thing to get here is that the algorithm's hunt for liquidity isn't random at all. It follows this very precise, ordered sequence.
All right, theory is one thing, but let's see how this whole thing actually works in the real world. We're going to walk through a trade example on the Aussie dollar daily chart, and you'll see how blending time and price can give you a super clear plan of action. Okay, so here's the chart. The very first thing we do is apply our time component. You can see we've marked out the 20, 40, and 60-day ranges. Just doing this one simple thing immediately frames the price action. It gives us a clear field of play for our analysis and stops us from getting lost in, well, endless historical data.
So with our time windows defined, the next step is to conceptually overlay our PD array matrix. We look at where the market is trading right now, and we start pinpointing all the potential premium arrays above that price and all the potential discount arrays below it, all within our defined look-back period.
And now things get really interesting because we can get super specific. If we just look inside that most recent 20-day window, we can identify key levels. Up in that premium zone, we see an old high and a rejection block. And down in the discount zone, there's a really clean bullish order block. Right away, these become our potential areas of interest, either for setups or for targets.
But here's where it gets real, because trading isn't always perfect. In this particular week, the initial idea was actually bullish, looking for a breakout higher. But it failed. And this is such a crucial lesson from ICT. A failed analysis isn't a loss. It's actually new information, and it can give you an even better trade in the opposite direction.
So let's zoom into a 4-hour chart
and see what happened. When that bullish idea failed on Tuesday, the analysis flipped immediately. The focus shifted from buying at a discount to selling from a premium, and the new target, a discount array. And just look at this. There was a clear liquidity void sitting right below the market on the 4-hour chart. That became the new high-probability objective. Price was just drawn to it like a magnet.
And this is the beautiful result. The price action for the entire week laid out a perfect market maker manipulation template. It put in the high of the week on Tuesday by running the liquidity just above Monday's high, and then it spent the rest of the week selling off to go find that discount PD array, the liquidity void we spotted. You see how it all just fits together?
So what's the bottom line here? What does this all mean for you? It means you now have a structured, repeatable process that you can apply to any market you trade. And that gives you a massive analytical edge. Let's just quickly recap the steps.
Here it is, boiled down into 4 simple steps. Step 1. Define your time by mapping out those 20, 40, and 60-day ranges. Step 2. Identify your price levels by mapping the premium and discount PD arrays. Step 3. Formulate your directional bias. Where is price likely headed? To a premium or a discount level? And finally, Step 4. Refine your entry and target on a lower time frame.
So the most crucial point is this. When you start to blend time and price using this framework, you begin to see a kind of symmetry in the market that most retail traders completely miss. You are literally aligning your analysis with the exact parameters the interbank algorithm uses. And that, my friends, provides a powerful, distinct edge.
And that's a wrap on how you can use time and price to build a repeatable analytical edge. If you found this breakdown helpful, do me a favor and hit the like button and subscribe to the channel for more content just like this. And if you have any questions at all about this process, just drop them in the comments below and a real human will get back to you. Safe trading out there.